While everyone else is running around screaming and crying about the recession, I've decided to beat the recession at its own game by using it as an opportunity to get insanely wealthy. In this video, I'm about to reveal my exact plan that you can follow too. The truth is that recessions happen on a regular basis, and if used correctly, it's possible to set yourself up for the rest of your life through some incredible opportunities and discounts. Even Warren Buffett has been quoted as saying, "Bad news is an investor's best friend." So let's talk about what you can expect over the next 12 to 24 months and exactly how you can use the recession to set yourself up for life. But first, you need to understand how recessions actually work. Generally, recessions are accompanied by a significant rise in unemployment, a drop in wages, a loss in consumer confidence, and a decline in values across everything from stocks, food, energy, and services, sometimes with long-lasting effects throughout the entire world. Second, along with a recession usually comes a decrease in earnings. Every quarter, companies report their revenue, and large media companies begin to publish news on their future outlook. But lately, they've been cutting back, leading to slow or even negative growth and inciting recession risks at the highest levels in 10 years. All this leads us to layoffs. When consumers earn less, they spend less, and when companies see a drop in demand, they cut down on spending to save money. And guess what the biggest expense is for most companies? Their employees. Tech companies are notorious for firing employees as soon as they notice any sign of a recession, because paying their employees is by far their biggest expense. Some of these companies are paying over $200,000 per year to fresh college graduates. For example, Facebook recently laid off over 10,000 employees during signs of a recession in the upcoming year. And they're far from the only ones to do so. A quick Google search for mass layoffs will show you dozens upon dozens of companies that are all cutting down their workforce. And as Bank of America explains, the US economy will start losing 175,000 jobs per month. So in terms of what this means for you and your investments, as well as how you could use this information to make you money, let's start with number 1, stocks. As of now, all three major indexes are down between 20 and 30%, with analysts like JP Morgan who believe that we have another 20% to go from current levels. However, if we take a look throughout history since 1946, the average bear market drop has been close to 30%, with the most severe being in 2009 when the S&P 500 fell 57% from its peak. Now, once you combine with the average with a recession, bear markets tend to do even worse, with an average drop of 34.8%. All of this is to say that generally, the absolute bottom occurs when we see capitulation across investors. Usually, that's a time to start the recovery, and things begin to bounce back. I'll cover exactly how much you can make from this in the next few minutes, but first we have to talk about number 2, real estate. Even though every area is different and some locations continue to flourish, housing declines on a national level are incredibly rare. In fact, as you can see throughout the last 60 years, there have been only a few times where prices meaningfully fell more than 10%. But now the general Wall Street consensus is that national housing prices are going to decline by 7%, with a worst-case decline of 10 to 15% should interest rates continue to increase. Of course, every market is going to be different, and according to Moody's analytics, the most vulnerable markets could see upwards of a 25% decline from the peak. This includes parts of Florida, Arizona, Idaho, and Southern California, with a decline lasting another 12 to 18 months before bottoming out. Now, in the big picture, it's probably going to make a small difference for anybody with a fixed-rate mortgage who intends to stay in their property for another 5 to 10 years. But for anyone looking to invest or buy a house, we may begin to see some deals starting to come on the market, which we'll cover shortly, because we have to also talk about number 3, cash. Cash is trash, right? Well, maybe not. So far, there's been a mindset that cash is losing value to inflation really quickly. But when every other asset is falling in price, sometimes cash could be the safest place to store your wealth. And when someone like the billionaire Ray Dalio admits that cash is no longer trash, you should at least reconsider your position. Many people forget that as recently as 2018, cash was the best performing asset. And if you had just been saving your money in a high-yield savings account, you would have far outpaced the market. Cash is now becoming such a significant part of the portfolio that even fund managers are holding on to the highest amount of cash since 2001. And Citigroup said that cash is the only asset that investors could use as a recession hedge. Now, viewers of my channel might call me out for being a hypocrite, because I've made several videos trashing cash as well. But allow me to explain my position. I personally believe that holding on to lots of cash is a bad idea in almost any economy, because investing will almost always give you a better ROI over the long term. This is backed by over 100 years of stock market data that you can find with a quick Google search. Just look at the historical performance of the S&P 500 index fund. I also believe that it's a good idea to diversify your income across different asset classes to give yourself a fighting chance against a global depression. All of this isn't to say that I think cash is trash and you shouldn't have any of it. I think it's a great idea to always have a small amount of cash on the sidelines in case of an emergency. But an emergency isn't the only reason to hold on to some extra cash. Cash is power. Think of it as raw energy that you can direct towards any business or financial endeavor to make more money. Having cash on the sidelines puts you in the position to swoop in and take advantage of really good deals. First, everything becomes less expensive. The way I see it, even though a lot of poor people think that you're dumb for investing in the stock market when everything is falling 30%, a wealthy person would see this as an opportunity to be able to buy those exact same companies for a 30% discount. Warren Buffett has the perfect analogy for this. He's famously quoted for saying, "When hamburger prices go down in price, we sing. When hamburgers go up in price, we weep." For most people, it's the same thing with everything in life that they're buying, except for stocks. When stocks go down and you can get more for your money, people don't like them anymore. People should stop thinking of stocks like a gambler and start thinking about them as an investor with a long-term outlook, because a falling stock market could work to your advantage. Second, there's less competition. The fact is, when times are difficult, companies scale back, they fold, they hoard cash, and they play it safe. But this opens the door for smaller, more aggressive companies to stand out and take their place. For example, one study across 16,000 companies found that those who continued to advertise increased their income and got more bang for their buck with positive growth years after the recession ended. Third, there's way more opportunity. In a way, a recession is like natural selection. It eliminates the weak. The patient and analytical survive, and the foolish and desperate get wiped out. A wise investor made a fantastic comparison a few months ago that the peak of the market cycle is like a forest. Only the largest, most established trees, or companies, get access to all the resources, which in this case is sunlight. Everything at the bottom has a difficult time being able to compete, and it's hard to grow. But just like natural forest fires, our economy has a way of repeatedly clearing out and bankrupting the companies that are no longer able to sustain themselves, giving opportunities for newer, smaller businesses to continue to develop. Fourth, after every bear market comes a bull market. As Yahoo Finance points out, historically the S&P 500 has fallen an average of 29% around recession, with a median drop of 24%. But when stocks have bottomed out, their average return the following year is 40%. And within 2 years, the market has increased an average of 58%. This means continuing to invest as stock prices go down is much more profitable than pulling out and trying to reinvest when prices start to go up. Long term, the market has always recovered after every single recession throughout history. So the simple lesson here is that when the market is crashing, stay in, don't pull out. And finally, you have to act before anyone else knows about it. I know it sounds easy to think, oh perfect, I'll just invest during a recession. But the truth is, recessions are never confirmed until much, much later. For example, the Great Recession that began in December of 2007 was not officially announced until December of 2008, only a few months before it officially ended. The recession before that began in March of 2001, but they didn't call it a recession until November later that year. And this trend continues with about a 6 to 12 month delay until we actually know we are in a confirmed recession. Now this is the most important part of the video, so pay attention. Here are the simple steps you need to follow if you want to profit from the recession. Number 1. Scale back your expenses. This means that you track your market, cut back on unnecessary spending, and operate lean while you continue reinvesting as much as possible back into the market. I would recommend investing in a broad market index fund, such as the Vanguard S&P 500 Index Fund, to reduce your risk. You should also have a plan on what you would do if your income were to drop 20 to 50%. For example, if you suddenly lose your job, how would you make up the difference? And what can you do ahead of time to protect yourself from this scenario? In a few minutes, I will share what I do to protect myself from a sudden decline in income, and why you should consider doing the same. But for now, let's move on to Number 2. Hold on to some cash. Now, I'm a firm believer that even though statistically your money is best off invested as soon as possible, there is something to be said about the peace of mind of having cash on the sidelines just in case things go south. For me, cash makes up anywhere between 5 and 10% of my portfolio, depending on the time of year. But generally, this has given me so many opportunities to jump on good deals when I find them. And it lets me sleep peacefully at night knowing that no matter what happens, I have cash in the bank to fall back on. Having cash also protects you from a sudden expense, so that you don't have to take on a high-interest loan to pay for it. Number 3. Protect your income. This, at the end of the day, is going to be your best hedge against whatever happens. If we're being honest, your worst-case scenario is not the market going down, but instead, it's the market going down at the same time you lose your job, forcing you to sell off your investments at the bottom before they have time to recover. This gets even worse if your job was your only source of income. I find it so strange how the same people who obsess over diversifying their investments never think about diversifying their source of income. Unless you have millions of dollars invested, you're probably still relying on your job to pay the bills. And if you lose your job, you either go into debt or sell your investments at a loss. That's why I recently started a passive income side hustle while still keeping my normal 9-to-5 job. In my opinion, it's the best way for beginners to supplement their income and protect themselves even if they lose their job. If you want to try it out, I've included a link in the description that will explain everything. Now is the best time to improve yourself, learn new skills, and add another source of income to protect yourself from financial troubles. And after that, Number 4. Invest long-term. The best course of action when it comes to investing is to simply carry on as usual and pretend like nothing's happening. It's been proven countless times that dollar-cost averaging, or the practice of buying into the markets on a regular basis, is the most profitable strategy. So stay in the market and continue buying in. Number 5. Diversify your investments. Now, if you can't personally handle a 20% drop without panicking, it's probably a sign that you're investing too aggressively. For instance, if you're completely in US tech stocks, then it's probably a good idea to add large caps and international stocks to the mix too. Or potentially look into investing in real estate, because people will always need a place to live in. The more legs your portfolio has to stand on, the less likely it's going to collapse should one or two of them break. So in general, this is also a great time to double down on your work, start a passive income side hustle like the one I mentioned earlier, and learn as much as you can. Because whatever you do today is going to be rewarded many times over by the time the market recovers. It's definitely not going to be easy, but rest assured, it will be rewarding for those who stick it out. The video on your screen will show you some of the best side hustles I've discovered over the years. But if you're looking for the best opportunity, click the link in the description to learn about my favorite side hustle of all time.